What if I told you that the market crash you're so afraid of could actually be your biggest opportunity to build wealth? So welcome back to Master the Market series. I'm Rohan, and today I'm going to show you why some investors are quietly celebrating while others are involved in panic selling during market downturns. Now, in the last major correction, one of my viewers followed the strategy I'm about to share with you today. While his friends were pulling money out of the market in a fear, this guy stayed disciplined with his SIPs. Now, 3 years later, his portfolio had outperformed by over 37% when compared to the portfolio of their friends. In the next 10 minutes, I'll reveal why Warren Buffett says your emotional discipline matters more than your IQ when it comes to investing. The counterintuitive reason market crashes actually help disciplined SIP investors make more money. The exact 4 mutual fund category you need in your portfolio for long-term wealth creation, and a powerful withdrawal strategy that even seasoned investors often overlook. Whether you're investing 5,000 or rupees 50,000 per month, these principles remain the same. So let's dive in. Section number 1, understanding market volatility. Let's start by addressing the elephant in the room, the geopolitical tensions and market volatility. See, these headlines might seem scary, but here's something the financial media will never ever tell you. See, geopolitical crises are nothing new to the market. From the Cold War and the Indo-Pakistan conflicts in 1970s to the 9/11, the parliament attacks that took place in early 2000s, the market has always faced a turbulence because of these events. Yet, if you look at the Nifty chart, it always uptrends in the long run. Despite all these events, the Indian market has consistently trended upward over the long term. See, this is the power of India's growth story. Geopolitical events will come and go, but trying to time the market on these events is likely to lead to regret in the long term. The key isn't about predicting these events. It's about having a strategy that works regardless of such events. I'll share my personal experience. I have seen the markets falling in short term due to the Russia-Ukraine war, the Balakot strike, the Uri surgical strike, and also Operation Sindoor. But that fall is always in short term. Within few months or weeks, market bounces back. So don't postpone your investment or your SIP journey thinking that I'll start my investment journey when the world becomes a peaceful place to live. Guys, that's not going to happen. Section 2, the power of SIPs in falling markets. Now, this brings us to the most powerful tool in your investment arsenal during market downturns, the SIP. Now, when markets fall, something magical happens with your SIP investments. It is called as the rupee cost averaging. And here's how it works. Imagine you invest 10,000 rupees every month in a mutual fund. Now, when the NAV is rupees 100, your 10,000 rupees of investment will get 100 units. But when the market crashes and say the NAV drops to rupees 80, that same 10,000 that you invest now buys 125 units. Now, let's see what happens when the market recovers and the NAV rises to 120 rupees per unit. Your 100 units bought at an NAV of 100 rupees have appreciated, that amount of 10,000 has appreciated to 12,000 rupees, which is 20% gain. But your 125 units that you had bought with the same 10,000 rupees when the price was 80 rupees, when the NAV was 80 rupees, is now worth 15,000, which is a 50% gain. This is why I get excited when the markets fall during my accumulation phase. My SIPs are literally buying assets, mutual funds at a discount. Yet, this is exactly when most investors make their biggest mistake. Study shows SIP cancellations spike during a market downturn, precisely when they should be continued or even increased, because market downturn is an accumulation phase. You have to buy, but that's a time when people cancel their SIPs. As Warren Buffett rightly says, success in investing doesn't correlate with your IQ. What you need is the temperament to control urge that get other people into trouble. Section 3. Portfolio protection during bear markets. Now, should you just blindly continue all your investments during a market crash? Absolutely not. Bear markets are not the time for maximum caution, but bull markets are the time where you have to be cautious. The real danger is during the bull market when you are overpaying for fundamentally weak companies, because in a bull market, all stocks enjoy a rally. But when markets fall, it's a time to review your portfolio with the following questions. Number 1, ask yourself, which investment did you buy purely on the basis of momentum or tips? Second question, which investment represents fundamentally strong businesses with good long-term prospects? The same applies to your mutual funds as well. For thematic funds that have declined significantly during a market fall, reevaluate your original investment thesis. For funds with strong investment philosophies and consistent processes, consider staying invested or even increase your position, increase your investments in such mutual funds. And in case if you have a thematic fund which is showing a downtrend because of market crash, better sell it off and stick to those funds which are fundamentally strong. See, market corrections are when the best fund managers prove their worth. Look at your fund's performance relative to its benchmark during a downturn and not just during bull runs. In a bull market, all fund managers can give you superb returns, but the character, the efficiency, the skills of a fund manager is tested when the market crashes. Section number 4 is understanding benchmarks. Speaking of benchmarks, let's quickly understand their importance. See, SEBI has standardized benchmarks for different fund categories to ensure a uniformity. For example, the large cap funds are always measured against either Nifty 50 or the S&P BSE 100. But here's the key. Don't judge performance over just 3 to 6 months. Even the best fund managers may underperform or sometimes show a great performance in 3 to 6 months in such a short term. Look at 3 to 5 years. This is the best period to truly assess if your fund is adding value which is over and above its benchmark or not. Section number 5 is your SWPs, the systematic withdrawal plan, the secret weapon for goal achievement. Now let's talk about what happens when you actually need to use the money that you have invested. This is where the systematic withdrawal plan come in. They are just as powerful as the SIPs. Now think of SWP as reverse of SIP. Instead of investing a fixed amount regularly, you are withdrawing a fixed amount regularly, and that's SWP. Now, here's why this matters. See, imagine you have been saving for your child's education from past 15 years. Now the big day arrives and you want to withdraw those 20 lakh rupees. But what if the market has just crashed by 20% at the time when you want to withdraw? See, the value of your investment also crashes, and this is a problem. So with an SWP strategy, you can start withdrawing systematically 12 to 18 months before you actually need the full amount. So, this spreads your withdrawals across different market levels and thereby reducing the risk of having to redeem everything when the market is at its low. This is what I call SIP in, SWP out, the complete cycle of disciplined investing. Section 6 is the core mutual fund portfolio. Finally, let's simplify your mutual fund selection. See, you don't need 15 different funds in your portfolio. Just focus on these 4 categories and your work is done. Number 1 is the large cap funds. Now, these funds are needed in your portfolio for stability because they invest their money in established and big businesses. Second are the mid cap funds. They are required in your portfolio for higher growth potential with a moderate risk. Third is the flexi cap fund, which gives your fund manager the freedom to invest across different market caps. And last is the multi-cap funds, which ensures a balanced exposure of your money across large, mid, and small cap companies. The allocation between these will depend on your age and your risk appetite. Say, if you are in your 20s or 30s, then you might put more of your money into mid caps. But as you approach to your 40s and 50s, you gradually increase your investments into large cap and lesser money into small cap and mid cap. For goals that you want to achieve within 2 to 3 years, consider adding hybrid funds that combine equity and debt. This will help to reduce volatility in your portfolio. So there you have it. All the above strategic approach to mutual fund investing can work in any market condition. Remember, market volatility is normal and temporary. SIPs are the most powerful when market falls. Review your portfolio, but don't panic sell during market downturns. And importantly, use SWPs to protect your gains when you are approaching your goals. See, keep your core portfolio simple but diversified by investing into the 4 categories of fund that I've already discussed above. And finally, if you found this video valuable, hit that like button and subscribe for more such wealth building strategies. This is Rohan signing off for today. Meet you in the next video. Till then, bye-bye. Take care. Jai Hind.